When people hear the phrase, betting against the stock market, their first reaction is usually skepticism. After all, the stock market has historically gone up over the long term. It's the place where wealth is built, retirements are funded, and dreams of financial freedom are achieved. But what if I told you that in 2025, the very same market that so many people trust blindly may be setting itself up for a serious correction? What if instead of riding the wave of optimism, meant the smarter strategy is to step back, question the hype, and prepare for what could be one of the most pivotal financial moments of the decade? See, here's the thing: the market doesn't move in straight lines. It moves in cycles, booms followed by busts, highs followed by painful lows. And right now, when you look beneath the surface of stock market headlines, earnings reports, and Wall Street optimism, you'll start to see cracks forming. Investment. There are red flags everywhere: inflated stock valuations, rising interest rates, consumer debt hitting record highs, and geopolitical uncertainty shaking confidence. Put all of that together, and it creates a picture that isn't very comforting if you're someone heavily invested in equities without a safety net. But let's get one thing clear: this isn't about fear-mongering. I'm not here to say the world is ending. Investment is that the market is going to zero, or that you should sell everything you own. Betting against the stock market doesn't mean abandoning it forever. It means being strategic. Investment. It means recognizing when the risks outweigh the rewards and positioning yourself in a way that protects your wealth while still leaving you in control of your financial future. Think about it this way. Investment. If you walk into a casino and the odds are stacked against you, do you keep gambling until you lose it all, or do you step back, pocket your winnings, and wait for a better opportunity? The stock market, especially in a year like 2025, is no different. Right now, we are entering a phase where the odds aren't necessarily in the investor's favor. High flying tech companies are trading at multiples that make no logical sense. Corporate debt is ballooning. And the Federal Reserve's policies are forcing a painful adjustment across the economy. That's not a setup you want to ignore. And here's the part most people don't want to hear. Investment. The smartest investors in history didn't build wealth by chasing hype. They built wealth by being patient, cautious, and opportunistic. They sat on the sidelines when things looked too good to be true in a good investment. And they went all in when assets were undervalued and fear ruled the market. That's the mindset I'm applying to 2025. I'm not walking away from investing. I'm waiting for the right pitch. Over the course of this speech, I'm going to share exactly why I'm betting against the stock market in 2025 and what that means in practical terms. We'll look at the warning signs pointing to overvaluation, how rising interest rates and debt burdens are shaking the foundation of corporate America, what safer alternatives and hedging strategies you can use to protect your money, and most importantly, how to position yourself for long-term growth once the dust settles. The truth is, wealth isn't just made in bull markets, it's made in downturns too. The difference lies in preparation. If you can see the risks before the crowd does, you don't just survive a market correction, you thrive in it. That's the real smart finance strategy for 2025. Market cycles are one of the most fundamental realities of investing, yet they're often the most ignored. People love to believe that the current market environment will last forever. If stocks are going up, they convince themselves the climb will never stop. If stocks are going down, they think the world is ending. The truth is, markets move in cycles that have repeated themselves for decades: periods of expansion fueled by optimism and growth, followed by periods of contraction triggered by overvaluation, fear, or macroeconomic shocks. What makes 2025 particularly concerning is that we're not in the early stages of a growth cycle anymore. We're sitting at a point where optimism has stretched valuations far beyond reasonable levels. And historically, that has always been followed by a painful correction. When we talk about overvaluation, we're talking about the simple idea that the prices of assets, stocks in this case, are not aligned with the actual earnings power of the companies behind them. Price to earnings ratios, price to sales ratios, and forward projections are all showing levels that simply don't make sense when compared with historical averages. For example, tech companies with no clear path to profitability are trading as if they're guaranteed to dominate the future. Large cap companies are being priced at multiples that suggest never-ending growth in earnings, despite the fact that consumer demand is softening and debt costs are rising. Investment. This disconnect between price and reality is the classic sign of a market top. It's like buying a house during a housing bubble. You might convince yourself it's worth it because prices always go up, but history shows that bubbles burst. And when they do, those who bought at the top are left holding the bag. Now let's zoom out and think about what drives these cycles. Human psychology is at the core. Fear and greed run the market more than numbers on a balance sheet. During good times, investors become overly confident. They push prices higher and higher because they assume someone else will come along and pay even more. This is the essence of speculation, and we're seeing it play out across multiple sectors. Artificial intelligence, electric vehicles, and biotech are being valued as if they will reinvent the entire global economy overnight. While these industries may indeed transform the future, the timeline and scale of profits are often exaggerated, and when expectations fail to materialize, valuations collapse. The dot-com bubble in the late 1990s is the perfect historical example. Back then, internet companies with no earnings or clear business models were valued at billions of dollars, only for the bubble to burst in the early 2000s. Fast forward to 2025, and we're watching a similar dynamic unfold. Different industries, but the same psychology. Another critical factor in market cycles is liquidity. For the past several years, we've lived in an environment where low interest rates made borrowing cheap. Corporations borrowed aggressively, consumers relied on credit, and investors poured money into equities because the alternatives like bonds or savings account paid next to nothing. This flood of cheap money lifted asset prices to levels that were unsustainable. But with interest rates rising, the tide is going out, and we're starting to see who's been swimming without a life jacket. Companies that looked profitable when debt was nearly free are now struggling to refinance. Households that stretched their budgets to buy homes or cars with cheap loans are now facing crushing payments. Investment, this tightening of liquidity is the exact kind of pressure that exposes overvaluation and forces corrections. Market cycles also have a way of feeding on themselves. When prices are rising, more investors rush in, creating a feedback loop of higher and higher valuations. But when the cycle turns, fear takes over just as quickly as greed once did. Investors start selling, which pushes prices down, which causes more fear and more selling. Investment. This self-reinforcing cycle can turn what seems like a minor correction into a full-blown crash. That's why understanding where we are in the cycle is so critical. Right now, all the signs point to us being at the euphoric stage, where optimism is at its peak and risk is being underestimated. And if history is any guide, the next phase is not continued growth, but rather the painful unwinding of that excess optimism. Some might argue that markets always recover, and so why worry? And while it's true that in the long run markets trend upward, the timing of when you buy matters. If you invest heavily at the top of a cycle, you could spend years just trying to break even. For instance, during the financial crisis of 2008, many investors who bought stocks in 2007 didn't fully recover their losses until several years later. That's a huge opportunity cost. By recognizing overvaluation and understanding where we are in the cycle, you can avoid locking up your money in an environment where the odds are stacked against you. Instead, you can wait patiently for the inevitable downturn and buy assets at a discount, positioning yourself for outsized gains when the cycle eventually turns upward again. The takeaway here is that cycles aren't just abstract concepts, they're roadmaps. They've happened before, and they will happen again. Investors who ignore them do so at their own peril. In 2025, the combination of stretched valuations, speculative mania, and tightening liquidity suggests we're entering the part of the cycle where caution is not only smart but essential. Investment. Betting against the stock market in this environment isn't about trying to time every single movement or predict the exact day a crash will happen. Investment. It's about recognizing that the risk to reward ratio is skewed and making strategic choices to protect capital while preparing for the opportunities that always emerge on the other side of a downturn. Rising interest rates and mounting debt pressures are two of the most powerful forces shaping the market right now. Investment. And they're precisely why betting against the stock market in 2025 is a rational strategy. When interest rates climb, they don't just affect one small corner of the economy. They ripple through everything: corporate earnings, investment, consumer behavior, government budgets, and ultimately investor sentiment. And when you layer on top of that the sheer scale of debt in today's system, you begin to see why these pressures can weigh heavily on the stock market's future performance. Start with interest rates. For over a decade, we lived in a world of cheap money. The Federal Reserve kept rates at historic lows, which made borrowing easy for both corporations and consumers. Businesses refinanced debt at almost no cost, took out loans to fund expansion, or even used debt to buy back their own stock, which artificially boosted share prices. Consumers borrowed freely as well, using credit to buy homes, cars, and luxury goods, often stretching their budgets because low rates made payments look manageable. All of this activity created the illusion of endless growth, because money was circulating quickly and valuations were being propped up by liquidity. But the environment in 2025 is very different. Interest rates have climbed, and suddenly that easy money is no longer cheap. Investment companies that borrowed aggressively during the low rate years now face refinancing at much higher costs. Debt that once felt like a manageable tool for growth now becomes a heavy anchor dragging down profits. For example, a corporation that was paying 2% interest on billions in debt may now be looking at 6% or more. That difference slashes into earnings, reduces cash flow, and forces management to cut back on hiring, expansion, or even dividends. Investors see this squeeze and confidence in future earnings erodes. Lower confidence translates to lower valuations, which is one of the key triggers for a market pullback. The consumer side of the story is just as important. Rising rates directly impact mortgages, auto loans, and credit card debt. A family that could afford a $400,000 house when mortgage rates were 3% may now only afford a $300,000 house at 7%. That reduces demand in the housing market, which affects everything from construction jobs to furniture sales to real estate commissions. Car loans become more expensive, so fewer people buy new vehicles, which hits the auto industry and its supply chain. And credit card debt, already at record levels, is now even more punishing because of double-digit interest rates. Consumers who are paying more in interest have less money to spend elsewhere. And since consumer spending drives a massive portion of the US economy, the slowdown filters directly into corporate revenues. Slower revenues, coupled with higher borrowing costs, create a squeeze on profit margins, and which Wall Street cannot ignore. Now let's talk about government and corporate debt on a macro scale. The US government itself is carrying more than $34 trillion in debt, and as rates rise, the cost of servicing that debt skyrockets. Instead of using tax revenues for infrastructure, education, or healthcare, a larger portion of the budget goes just to paying interest. That creates long-term structural challenges that weigh on investor confidence in the broader economy. Meanwhile, corporate debt has also ballooned to historic levels. In many cases, companies took on leverage to grow rapidly or to engage in financial engineering like stock buybacks. Those buybacks fueled a large part of the stock market rally in previous years, but with higher debt costs, companies can't sustain that strategy. Without buybacks artificially lifting stock prices, valuations are left to stand on their own. And often, they don't look nearly as strong. One of the more subtle but dangerous effects of rising rates is the shift in investor behavior. When bonds and savings accounts were paying close to zero, equities were the only real game in town. Investors piled into stocks not necessarily because they loved the valuations, but because the alternatives offered no return. But in 2025, when bonds yield 4 or 5% or more, the calculus changes. Suddenly, an investor can earn a safe return without taking on the risk of volatile equities. That migration of capital away from stocks and into bonds or money market funds puts additional downward pressure on the stock market. It's not that investors are panicking. It's simply that they're relocating to safer, more rational opportunities, leaving stocks with less demand to keep prices elevated. Debt pressures also have psychological effects on markets. When investors see headlines about rising delinquencies on credit cards, auto loans, or corporate defaults, it chips away at sentiment. Markets don't just respond to numbers, they respond to confidence, and confidence is fragile. A few high-profile bankruptcies or missed payments can act as a spark that ignites broader fear, leading investors to sell off equities and further deepen the downturn. Put together, the picture is clear. Higher interest rates increase the cost of debt for corporations, strain household budgets, raise government liabilities, and shift investor capital into safer assets. Mounting debt, whether at the consumer, corporate, or government level, magnifies the pain of those higher rates and creates systemic risk that can't be ignored. This combination doesn't guarantee an immediate crash, but it does set up an environment where stock market growth becomes far harder to sustain. Betting against the market in such a climate isn't about pessimism. It's about recognizing these financial headwinds and acting with discipline before they fully manifest in declining stock prices. When most people think about investing, they default to the stock market as the primary or even the only vehicle for building wealth. That mindset works well in strong bull markets when stocks are climbing and everything looks secure. But when the economy is flashing warning signs, valuations are stretched and risk is elevated, relying solely on equities is like sailing into a storm without a life vest. This is where safer alternatives and hedging strategies become essential. They don't necessarily mean abandoning the stock market altogether, but they allow you to reduce risk, diversify exposure, and protect your wealth when equities aren't offering the right balance of reward compared to risk. In 2025, investment, when uncertainty is high, these strategies may not just protect capital. They can also position you to take advantage of opportunities once the market corrects. One of the most obvious alternatives is real estate. Unlike stocks, which can lose value overnight based on a bad earnings report or a sudden market swing, real estate tends to provide a more stable and tangible store of wealth. Of course, real estate isn't without risk. It can also experience downturns, especially if mortgage rates remain high. But in many cases, chosen real estate investments can generate steady rental income, which acts as a hedge against inflation and market volatility. The key is focusing on properties in areas with strong demand, limited supply, and long-term growth potential. While housing prices may cool in response to higher interest rates, that also opens the door for investors who are patient and liquid to acquire quality assets at more favorable prices. Another important alternative is bonds. For years, bonds were dismissed as unattractive because yields were so low that they barely kept pace with inflation. But in 2025, the landscape has changed. Higher interest rates mean bonds and even simple savings products like certificates of deposit or money market funds are offering returns that rival or surpass the historical average for equities without the same volatility. Adding bonds to a portfolio not only provides stability, but also creates income streams that aren't as tied to stock market swings. And in a downturn, bond prices often rise as investors seek safety, making them a valuable counterweight to falling equity valuations. Commodities like gold also deserve attention. Gold has always been seen as a hedge against uncertainty, inflation, and currency weakness. And whenever markets enter periods of turbulence, demand for gold typically rises, driving prices higher. Holding a portion of your wealth in gold or gold-related investments can act as insurance against financial shocks. Beyond gold, other commodities such as silver, oil, or agricultural products can also provide diversification, especially in times when supply chains or geopolitical tensions disrupt traditional markets. Cash, often overlooked, is another powerful hedging strategy. Investors are sometimes taught to think of cash as wasted potential, sitting idle and not earning much. But in reality, cash provides optionality. It gives you the ability to act quickly when opportunities arise. If the stock market does enter a correction in 2025, those with cash reserves will be in the strongest position to buy undervalued assets at discounts. Meanwhile, those fully invested in overvalued stocks will be forced to either ride out the downturn or sell at a loss. In that sense, holding cash isn't about missing out. It's about being prepared for the opportunities that only volatility can create. That diversification across asset classes is critical, but hedging strategies go even further. For example, some investors choose to hedge directly within the stock market by using instruments like put options or inverse ETFs, which rise in value as the market falls. While these tools require careful management and come with their own risks, they can provide a buffer during periods of steep declines. The point isn't necessarily to make massive profits from shorting the market, but to balance the portfolio so that losses in equities are offset by gains elsewhere. Another layer of hedging is geographic diversification. If the U.S. investment market is entering a period of weakness, investors might look to international markets where valuations are more reasonable or where economic cycles are at different stages. Emerging markets, for example, can offer growth opportunities independent of U.S. dynamics, though they carry unique risks as well. By spreading investments globally, you reduce the impact of a downturn in any single region. The real advantage of alternatives and hedging strategies is psychological as much as financial. When investors feel overexposed to equities, every dip in the market creates stress and panic, leading to poor decisions like selling at the bottom. But when a portfolio is balanced with real estate, bonds, commodities, cash, and hedges, the volatility of stocks doesn't feel as catastrophic. You know you have other pillars supporting your wealth, and that allows you to act with patience instead of emotion. The ultimate goal is not to avoid risk entirely, because risk is an unavoidable part of wealth building, but to manage it intelligently. In 2025, with markets showing signs of strain and uncertainty, alternatives and hedging strategies provide a way to stay invested without being overly dependent on equities. They give you resilience, flexibility, and peace of mind. And perhaps most importantly, they put you in a position to not just survive a downturn, but to thrive when the cycle inevitably resets and assets can be bought at far more attractive valuations. Positioning for long-term growth is the part of the strategy that often separates those who merely survive downturns from those who actually build extraordinary wealth because of them. Betting against the stock market in 2025 doesn't mean abandoning investing forever or retreating into fear. It means understanding the environment, preserving capital, and waiting for the right opportunities to appear. History has proven time and again that the greatest fortunes are made not during bull markets, but during the moments when everyone else is panicking and assets are trading at deep discounts. The key is being prepared, patient, investment, and disciplined enough to act when the time is right. When markets correct, fear dominates investor psychology. People rush to sell their stocks, often at the worst possible time, because they can't handle the losses on their screens. This is exactly when disciplined investors who've held back capital can step in. They're not buying out of desperation, but out of strategy, knowing that great businesses are temporarily undervalued because of widespread panic. Think back to 2008 during the financial crisis. Companies like Apple, Amazon, and even large banks saw their stock prices cut in half or more. And those who had cash and the courage to buy when the market was collapsing built incredible long-term wealth in the decade that followed. The same principle applied after the dot-com crash, after the 2020 pandemic shock, and it will apply again in the next downturn. The preparation for this moment starts long before the correction hits. That's why taking a cautious stance in 2025 matters so much. By reducing exposure to overvalued equities, holding cash or safer alternatives, and positioning in assets that hedge risk, you're essentially building a war chest. When the market eventually stumbles, instead of scrambling to minimize damage, you're calmly analyzing opportunities, deciding where to allocate capital, and buying quality assets at a fraction of their former prices. This proactive posture is the essence of smart investing. Another piece of long-term positioning is focusing on fundamentals rather than hype. Investment in overvalued markets. Investors often chase speculative names because they're popular, even though the underlying businesses are weak. But in a downturn, fundamentals come back into focus. The companies that survive and thrive are those with strong balance sheets, consistent cash flow, and real competitive advantages. These are the types of businesses worth buying during a correction because they not only recover, they often emerge stronger as weaker competitors get washed out. Positioning for long-term growth means having a watch list of such companies ready so that when prices fall, you don't waste time figuring out where to put your money. You already know which businesses are worth owning for the next 10 to 20 years. Timing also plays a role, but it's less about predicting exact bottoms and more about scaling into opportunities. Rarely does anyone buy at the absolute low. Instead, smart investors average enduring periods of weakness. By spreading out purchases over time, they reduce the risk of mistiming and ensure that they're consistently buying at better valuations than during euphoric highs. This gradual approach to entering positions is part of the discipline that defines successful long-term strategies. And beyond equities, long-term positioning also includes building a diversified base of assets. Real estate, for example, tends to hold long-term value and provide income even when markets are volatile. Bonds can anchor stability and deliver steady returns. Commodities, as hedges, offer insurance against inflation or geopolitical disruptions. By creating a balanced portfolio that can weather different economic climates, you're not just betting on one outcome, you're preparing for any outcome. That resilience is what keeps long-term strategies intact even when short-term chaos dominates headlines. Patience is another underrated part of this equation. Many investors struggle to sit on the sidelines, especially when they see others making quick gains during market rallies. But the discipline to wait for the right conditions is one of the most powerful tools you have. Holding cash or safer assets during uncertain times might feel boring, but it's precisely that patience that positions you to act decisively when opportunity finally knocks. The market rewards those who can resist the urge to follow the crowd and instead move against the tide when valuations make sense. Finally, positioning for long-term growth isn't just about investments, it's also about mindset. If you view downturns as disasters, you'll act emotionally and miss the opportunities they present. But if you view them as inevitable parts of the cycle, and even as necessary resets that clear out excess and create new chances, you'll approach them with clarity. The investors who build lasting wealth aren't the ones who fear volatility. They're the ones who embrace it as a natural part of the process. So when I say I'm betting against the stock market in 2025, what I really mean is that I'm betting on the cycle. I'm betting on the fact that overvaluation doesn't last forever, that corrections create opportunities, and that patience and preparation always pay off in the end. Long-term growth doesn't come from chasing short-term gains in overheated markets. It comes from recognizing when to step back, when to protect capital, and when to strike. By thinking ahead, diversifying intelligently, and staying disciplined, you don't just survive uncertain times, you set yourself up to thrive when the cycle turns in your favor.